Trading last week was divided into two parts. The first part of the week was fairly benign. Markets were flattish, volatility was low, but that all changed on Friday night. We saw selling hit the market as fears about the outlook for the global economy rose, and that selling meant that we had a pretty poor week for investors all around the globe. Pressure on US markets on Friday night saw them finish for the week down around 2.5%, and it was even tougher in other parts of the world. The Hong Kong market finishing down by more than 3%, and that was before the real ructions hit on Friday night. Finance company reports will lead in the US this week. We're getting back into the quarterly reporting season there. And of course, we'll kick off with the traditional first riders here. Finance stocks, generally speaking, JP Morgan, Wells Fargo, and Bank of America, all on the agenda this week. And we'll get our first check on the latest quarterly look at the health of the US corporate world. We'll also see RBA minutes this week. Tomorrow they'll be released, and we've got employment data coming out on Thursday. And the combination of those two could really inform Australian trading in the days and weeks ahead. At the moment, the actions of central banks and their dependence on inflation and jobs data mean that both the minutes from the RBA and the jobs data on Thursday will be closely watched. And this week we'll also get inflation data in the US on Wednesday night, and on Thursday night, jobless claims. Now, these are generally very important, particularly as they speak to the Fed's dual mandate, inflation and jobs. However, this week, I suspect that the market action is going to be dominated by the news that hit on Friday night, and that big ramping up in the conflict between the US and China over trade matters looks like it'll be the main driver of market action this week. It was clearly that talk on Friday night that really spooked the markets. Now, I know that markets were shrugging off these announcements from both countries over the previous couple of months. That market had taken the view that these announcements and the introduction of tariffs and then their deferral were all negotiating tactics around getting better terms for each nation in its negotiations. But that all changed last week. Rare earths are the most strategic commodities in the world at the moment. Their use in particular in cutting-edge industries in everything from consumer electronics to military guidance systems means that they are essential to every major nation's prosperity. And China dominates the global production of rare earths with around 90% of all production. And the restrictions it announced last week on sales of rare earth minerals really rattled particularly US markets. And the response from the White House is an indication of just how strong a stance was taken by China last week. During trading on Friday night, we saw a post from President Trump promising retaliation for the introduction of restrictions around rare earths. And then after the market, and despite the fact that the market had already fallen sharply following the first announcement, after market, President Trump announced a 100% increased tariff on China goods and services. Now, that, of course, is what is likely to rattle traders this morning. We saw a big hit to futures in trading on Friday night for this region, with both Nikkei and Hang Seng futures down by around 5%. Australia didn't fare quite as badly, but nonetheless, it's going to be a very torrid trading day as we work through the implications of that escalation in the trade dispute between the US and China. Futures are indicating it'll be a tough night's trading in the US and in Europe as well. So plenty to be looking out for at the moment. It does look like volatility at the very least is going to spike. Of concern to me was the number of people who have already come out with a buy the dip call. I think we've seen a sea change in the way the market is thinking about these two key aspects. One is trade, and the other is interest rates, because tariffs are inflationary. And if tariffs are the cause of a slowing in the global economy or a slowing in the US economy, central banks' ability to respond with lower interest rates is restricted. So tariffs are the worst formula for this market at the moment, because not only do they slow everything down, they tie central banks' hands. And that's why we're seeing such a severe reaction at the moment. Nonetheless, the dip buyers have done very well over the years. They could well be right again this time. My sense is things have changed more than that, but time will show who's right. We've now got plenty of pressure across the board. In the US, Nvidia, Amazon, Tesla, Broadcom, all down 5% or more. Investors are bailing out of the formerly glamorous stock. So where a stock has outperformed very strongly, where it's been popular for a long time, where it's trading on a very stretched multiple, is where we're likely to see the heaviest selling emerge, something to watch out for. Where the buying opportunity is and whether it's this week, next week or next year is still a very open question. Investors will have to decide for themselves, but a sudden change in momentum like this from sharply upward to sharply downward at least means a big increase in volatility and could see further downward pressure in the very short term. So looking at some of the stocks on our watch list today, Nvidia down almost 5% on Friday night. Now, it's still well up from the year. Let's remember, it's pulling back from all-time highs. So it's still within touch of those all-time highs. But the pullback did bring it back into a previous sideways trading zone. And while it stays below 184, there could be more pressure on Nvidia shares as it moves towards the floor of that previous trading range. A number of analysts still have a strong buy on it. In the Moo community, there's still a strong buy from analysts, but the potential to fall further in the short term, at least on the chart, looks very real. Turning to local stocks, South32 has been outperforming recently. Now, we've been watching the mining stocks very closely all year as surprises in the resilient nature of the underlying commodity prices has started to show up in share prices, and South32 has been a beneficiary of that. Last week, its shares were up 12.5%, and it's up more than 20% for the month. There's a lot of optimism over what some have described as its vital resources position. These were once the most unloved resources at BHP. Remembering the origins, it looks like the commodity cycle has swung full for South32 on that basis. A number of buy ratings on the stock once again in the community and on the platform. You can see those buy ratings. A lot of analysts are looking at the cash flow and suggesting South32 may be undervalued. And just to finish up on the thematic for today, MP Minerals is listed in the US. The code is MP. It's a rare earths miner, and naturally enough, given what was driving the news cycle last week, it was up strongly. 9.6% for the week, 71% over the past 3 months, and 400%. Over the previous 12. So it's now at an all-time high. There is clear upward momentum, but very jagged trading. Investors considering MP Minerals and Materials would be advised, I imagine, to be very cautious about where they enter, but nonetheless, a very interesting business in the current environment. Once again, plenty of buy ratings. It has already received investment from Apple and the US government. And I think that confirms its potential strategic opportunity. Entry price might be a little more problematic, but MP Materials are stock right on theme for trading this week.